There are thousands of businesses and hundreds of business models. Judging all of them based on just PE or someone else's opinion is stupidity, which is fun until you start losing money. In this video, I'm going to explain how you can understand a business like a pro. I'll use a business we can all understand as an example, a coffee shop. Let's start from the quarterly statement. This part shows how the company did in the 3-month interval. Consolidated means the numbers are combined with all the children companies, and standalone means the result is only for that specific company without any child company. So always look for consolidated numbers, because companies likes to hide the loss-making parts. Sales. It shows how much the business earned by selling coffee, or in simple word, how much money hit the cash register. Also known as the top line. Tech companies love this number. They will spend 100 rupees to make 10 rupees. Then they go on LinkedIn and scream, "We have 1000% revenue growth." Expenses. How much the business spends to earn all the money in sales. The coffee business shows how much they paid employees, or how much ingredients, furniture, etc. they bought. Operating profit. This is simple. How much money the coffee shop made by selling coffee after expenses. If this number is negative, it's a charity. They are losing money on every sale. Operating profit margin. This is important. It shows what % profit the business made from operations. The higher the number, more pricing power the business has. In simple, if the coffee shop can increase prices without losing much customers, it's a stronger business. Less profit margin means tight competition or weaker business. A real-world example of high-margin business: telecom, stock exchanges. Low-margin business: original equipment manufacturer. Other income. The coffee seller gets some interest in the bank. That income the business can show here. Or if they sold their old machines or furniture. Basically, they can show any income here that did not come from core business. Remember, when a business consistently shows more other income than its core business income, that's not a good sign. Interest. How much money he pays in interest, for example. The shop may have taken a loan to start the business. When debt is high, the business pays more in interest. Depreciation. All the items the shop uses in the business, like coffee machine or the furniture they use, that lose value over time. So here they show how much money they keep aside for those future replacements. Important. Many businesses don't show enough depreciation to make the profit number higher. For example, an AI company can use a 120,000 rupee graphics card for 1 year, so their depreciation each quarter would be 120,000 divided by 4 equals 30,000. But if they show they can use it for 5 quarters, 120,000 divided by 5 equals 24,000. This is risky, or sometimes illegal. Profit before tax. This shows the total income before taxes. If you only look at the final profit, you might get tricked by a one-time tax benefit. Profit before tax tells you if the business model works regardless of the tax rate. Tax. How much the shop pays to the government. Normally in India, corporate tax is around 25%. If you see a company paying 0% or 5% tax while making a profit, be careful. Unless they have a special government exemption, the tax man might come for them later, destroying future profits. Net profit. This shows how much the coffee shop actually can take home, after everything. In finance, we call this the bottom line, because it literally sits at the bottom of the statement. If this number is growing every year, the business is healthy. If sales is going up, but net profit is going down, the business is inefficient. EPS, earnings per share. Think of this as the profit your single share earned. This money doesn't hit your bank account immediately. The company has 2 choices. Retain it. They keep it to buy more goods or furniture, retained earnings, which makes the whole shop more valuable and pushes the share price up. Usually, growth companies prefer this. Distribute it. They send it to you as dividends. Usually, mature companies do this. Basically, high EPS means the shop is a money-making machine, even if you don't see the cash in your pocket today. Dividend payout percent. This is the percentage of the profit the business actually mails to you. But here is where most people get tricked. In India, companies announce dividends based on face value, not the price you paid for the share. If a company says 100% dividend on a share with a face value of 1 rupee, you only get 1 rupee. even if you bought that share for 500 rupees. Profit and loss statement. This part shows the same things, but in a yearly time frame, how the company did, and gives you a bigger picture. Balance sheet. Previous two parts tells you how much they made. This part tells you what they have. It shows what they own, assets, and what they owe, liabilities. Equity capital. It shows if the business issuing more shares to get capital. A flattish equity capital number is better. If this number keeps skyrocketing, existing shareholders' share value goes down. It's like ordering a pizza with your friends. You pay for a slice, but then 5 more strangers join the party and cut your slice into microscopic pieces. Reserves. Most businesses fail because they run out of money. Reserves show how much money the coffee shop actually holds for a rainy day. Borrowings. It shows how much debt the business has. If debt is higher than equity plus reserves, the business is highly leveraged, which is risky. Usually borrowings are high for infra, real estate, telecom businesses. Service-based IT, FMCG businesses are low debt business. If short-term borrowings consistently going up, it could be a sign they are in a debt trap. Other liabilities. This is the money the shop owes but hasn't paid yet, like the electricity bill or the salary for an employee that is due next week. Fixed assets. Fixed assets shows the values for real things the shop uses for the business, like a coffee machine or the chairs and tables, the things that help offer the core service or product smoothly. CWIP. Imagine the shop is building a new shop, but it's only half done. There are bricks and cement lying around. This asset is in progress. It's not making money yet. That's why it's called capital work in progress. Investments. Sometimes the coffee shop has so much extra cash they doesn't know what to do with it, so they buy stocks or puts money in mutual funds. That is shown here. Other assets. Cash in the drawer and the stock of coffee beans, sugar, or milk sitting in the pantry, etc. Cash flow statement. This is the most honest part of the report. As they say, profit is an opinion, cash is a fact. Cash from operating activity. This is the real truth detector. You can fake net profit by playing with depreciation or postponing tax, but you can't fake cash in the till. If the business shows a huge profit in the P&L statement, but this number is negative, it means he is selling coffee on credit, udhari, and not collecting the money. If he doesn't get cash, he can't buy milk for tomorrow. This number should be positive and growing. Cash from investing activity. This shows where the money is going for future growth. If this number is negative, it usually means the coffee shop bought a new, bigger coffee machine or opened a second branch. They are spending money to make money later. But if the business is selling his machines to generate cash, positive number, the shop is shrinking. Cash from financing activity. This is about the relationship with the bank and shareholders. Positive means he took a new loan, money came in. Negative means he paid back the loan or paid you dividends, money went out. A mature business usually has a negative number here because they are paying off debt. Ratios. This is the report card. It tells you how efficient the coffee shop actually is. Debtor days. How many days it takes for customers to pay. If the coffee shop lets people drink today and pay next month, his debtor days are 30. If he demands cash instantly, it's 0. You want this low. If this number jumps from 30 to 90, it means the seller is desperate for sales and giving too much credit to people who might never pay back. Inventory days. How long the milk and coffee powder sit in the shop before being sold as coffee. If they buy milk and it sits for 10 days, it spoils. You want this low. It means as soon as raw material comes in, it gets sold as coffee immediately. Days payable. How many days the coffee shop takes to pay the milkman or the sugar supplier. Here you want a higher number. If the seller buys milk today but pays the milkman after 60 days, he essentially got an interest-free loan from the milkman for 2 months. That's smart business. Cash conversion cycle, the full loop. Money out, buying goods, to make coffee, to sell coffee, to money in. How fast does this circle spin? The faster, the better. Amazon actually has a negative cycle. They take your money instantly, but pay suppliers later. Working capital days. How much money is stuck in the daily running of the shop? If this is too high, the business is a cash guzzler. It's like a car that needs too much fuel just to start the engine. ROCE percent, return on capital employed, the big boss of ratios. Imagine the seller put 100 rupees into the shop. Furniture, shop, machines. How much return did that 100 rupees generate? If the ROCE is 6% and the bank gives 7% on a fixed deposit, the business is useless. The seller should sell the shop and put the money in the bank. You generally want to see this above 15 to 20%. It proves the business is a money-making machine. Shareholding pattern. Who actually owns the shop? Promoters. These are the owners, the coffee shop owner himself. If their percent is high, like 50 to 70%, they believe in their business. If they are selling their stake every quarter, ask yourself, if the owner is running away, why are you entering? FII and DII. These are the foreign investors and domestic mutual funds, the big whales. They have teams of analysts visiting the shop and checking the books. If they are increasing their stake, it's usually a vote of confidence. If they are all selling, something is wrong that you haven't spotted yet. Public. That's us, the retail investors. Sadly, if you see the public holdings skyrocketing while promoters and FIIs are leaving, it usually means the smart money has exited and the general public is left holding the bag.